Hi, welcome to the Reyker Financial Product Team videos. Today I'm going to be talking to our Head of Product Development, James Chew, who's going to tell us a little bit more about our current product offering, the Reyker Dual Index Income Plan. So James, there's obviously a number of other income type products out there, such as equity income funds and bond funds. Why would an investor want to use the structured product?
Okay, yeah, the bond funds and equity income funds, as you mentioned, have indeed been very popular because of low rates in the last few years. Let's look at both. Both have been performing very well. Bond funds in particular have been quite spectacular last few years. The total returns have been very strong. Remember the word total return. That's income of capital gains. You're getting the total return, the positive performance, not only from the income from the bond, but because of capital gains of the bond. Where does the capital gains come from? Fall in bond yield. Because of quantitative easing, bond yield has been falling. Now obviously, over the last couple of months, we heard about Bernanke basically saying maybe we will be tapering the quantitative easing. Bond yield has gone up. Maybe this bond fund performance will have a reversal soon. So that's one consideration. Second, you mentioned about equity income funds. Very popular in the UK, mainly because a lot of the British companies pay a lot very good dividends. And UK equity income funds has been very popular. Fund managers pick stocks that will perform well and also have high dividends. You receive the income from dividend, but also share the capital gains because of the shares. Now, these have been performing quite well as well. Some commentators say because everyone is looking for yield, a lot of investors have been buying these type of high dividend stocks. So obviously, these funds and the shares go up. However, some commentators also say that actually it may come to a stage that it is quite overvalued. Maybe again, correction will occur soon. So yeah, these two type of income strategies are popular, have been generating positive return, but we think that actually it's about time investors consider some alternative. In this uncertain environment with quantitative easing possibly coming to an end, they may need some control to the risk, some protection to their capital. Therefore, we designed this. This is the investment thinking that we have behind the Dual Index Income Plan.
Okay, so what kind of investor should consider this product?
Well, equity income funds, the investors have been earning a lot of performance recently, and this is the type of investor that should consider using this structured investment. They could consider basically cashing out some of the positive performing equity income funds and switch to this one because there's some kind of risk control through the 50% barrier. The reason why I say equity income fund investors was because this structure, the incomes depends on the performance of two equity indices. FTSE 100, UK shares, and Euro Stoxx 50, Eurozone shares. And the best scenario for this product is that if these two indices both stay above 75% of the starting level at the end of every quarter over the next 6 years, then you got 1.8% every quarter. So that's the best case scenario. So compared to an equity income fund that generates a positive return if the shares goes up, plus a little bit of dividend yield, this particular strategy generates a positive income even if the indices stay flat, not drop more than 25%. Now the key is that the investor must understand that this performance is driven by the two indices performing in line with each other. If one up, one down, then you won't get the income. So that's the first thing to remember. Second thing to remember is that there's a kick-out feature for this plan. So if both indices have gone up by 5% or more from year 2 onwards and every quarter thereafter, you may get kicked out, got your money back, you could reconsider what to invest, but remember, income will be cut off early. There are a lot of investors who want a consistent, stable income regularly over the next 6 years. They should consider whether it's suitable for them. Lastly, as with any structured investment products, this plan, the income and repayment of capital depends on the solvency of an issuing bank. This plan, the security used or the notes that's going to be bought by the plan will be issued by RB National Treasury Services PLC, guaranteed by the parent Santander UK PLC. So you need to consider whether this is an acceptable credit risk for you or the investor, and especially considering whether the investor have already got a lot of exposure with Santander UK through day-to-day banking, or they have already invested in bonds with Santander UK, or they invest in structured products issued by Santander UK before. So,
okay, so in comparison to the funds which offer liquidity, sort of dealing, so I can buy and sell and rebalance my portfolio, my understanding is that with structured products you tend to be locked in for a period of time. In fact, this one, it's 6 years. So,
yeah, that's one common criticism about structured investment. You say you lock the investor is in. Firstly, there's a kick-out feature that I mentioned. If both indices, FTSE and Euro stocks, has gone up, then by 5% or more from year 2 onwards, every quarter, then you may get your money back. Now there's an automatic get-out feature. But another thing is, really now, structured investments, there's actually a market. You could actually redeem early. For this plan, there will be early redemption opportunity weekly, and you can find all the details in our brochures and terms and conditions there. Obviously, if you redeem early and if the market has gone down, then you may get less than your money back. But one thing that I'd like to point out actually is that we are different from other structured product providers in a way that we take monitoring the performance of structures very seriously. And we monitor it ourselves, look at the mark-to-market value of the structure, the value of the underlying investment, in these cases the 2 indices, and also obviously the strength of the counterparty. And if we are monitoring it ourselves, why don't I offer this service to help advisors like yourselves? And we'll alert you if certain things happen, like if the mark-to-market value of the structure or the underlying indices, the performance at hit certain threshold, we may contact you and tell you that this is what happened to this investment. Maybe you should approach your client, talk about early redemption opportunities, taking profit early, or maybe taking a small loss and consider another investment because the probability of getting a return may be lower now. So different things we could do, but this is the differentiation. So in other words, I'm not locking you in. I'm actually trying to help you that despite that it's a fixed term investment, by actively monitoring it together with you and your clients, you can still get out when the investment environments are changed.
okay, thanks James. If you'd like to find more information about our dual index income plan, you can read about it in the brochure. Alternatively, if you've got more questions or would like to know more information, then please feel free to contact us either on the phone on 020 7397 2580 or email us at rfp@reyker.com.